Welcome to Risk Roundup. From electronic banking to PayPal to digital wallet systems, Venmo and Square, as the progression of non-cash transaction evolves rapidly, the advances in technology is fundamentally changing the way we pay for goods and services. Any financial transaction that we would have undertaken with cash in the past are now increasingly being undertaken in many different digital formats. While over the years we have been completing financial transactions using credit cards and debit cards, it seems that even these digital solutions aren't innovative enough or to be made permanent or to be made de facto for the digital global age, which is changing every single day. So as the broader financial markets go through technology transformation, the competition in digital payment methods is getting fierce. And as a result today, cash seems to be no longer the dominant payment method across nations. So when the world is going through a fierce battle between different modes of digital payments and is experiencing a rapid and growing use of diverse digital methods of recording, managing, and exchanging money in commerce and investment and daily life, it is important to understand and evaluate which technologies are leading the evolution in digital payments. Where is the blockchain playing a role? Why are we moving towards a cashless economy? And what is going to be the impact of this cashless economy? To discuss cashless economy further, I am delighted to welcome Kary Bheemaiah to Risk Roundup. Kary is the author of The Blockchain Alternative and is from Paris, France. Welcome, Kary. It's an honor to have you on Risk Roundup.
Thank you so much for having me over as well, Jayshree.
Wonderful, Kary. So let's, for the benefit of our global viewers and listeners, let's talk very briefly about what is the cashless economy and why are we moving towards a cashless economy?
I think it's inevitable that it was going to happen. Digitization has been going on for quite a while, actually. So if we look at any kind of an asset over the past 30 to 40 years, we've been seeing a progressive transition to making it increasingly digital. And while this was happening quite easily, I wouldn't say easily, but it was happening quite rapidly for a number of assets, money, for some reason, seemed to have this kind of it was getting digitized as well, but it was extremely centralized, whereas a lot of the digitization was getting increasingly decentralized. And what's happening today is it's just a lot more easier to function in a universe which is essentially getting more and more digital, to have a digitally native currency. So I think it's just representative of the way that capitalism is evolving. Money is a bearer instrument. It is something which allows us to transact value. It is a representation or a proxy of value for any kind of an asset. And if your assets are getting increasingly digitized, then it just makes sense that the proxy of value that you're using for its transaction needs to be natively digital as well. So a lot of people probably don't know about it, or they probably do know about it, but around 97% of the existing cash already is digital. There's huge amounts of efficiencies which come with digitization, mostly with the reduction of transaction costs and the flattening of value chains. So it's also because of these kinds of efficiencies which we can't get through the regular fiat kind of a system that it makes more sense to go towards a more digital universe.
Yes, very true. Now, when we look at the state of cashlessness across nations, what broader trends you see are, being observed as far as the cashless economy goes? I mean, what the technology is the foundation. The digital technologies are, kind of driving and pushing this move towards the cashless economy. But when we look at the nations, what broader trends you are seeing that are either going to make those nations, very effectively move towards the cashless economy, or going to, have a problem, transferring or having the transformation towards the cashless economy?
Yeah, so transition is always a tough thing, especially when you've got systems which have been in place for a couple of 100 years, which have been tried and tested, and which have a certain trust attachment to it. People are used to using a certain methodology of operation. And when you say that, okay, fine, we're going to go towards something that's more digital, that's something that's a bit more different, you can't use the same kind of rules and regulations which you normally use in order to control something which is a physical asset. So that kind of transition is something which a lot of nation states are realizing. But at the same time, if your economy is increasingly digital, then you have to be able to kind of adapt to that. Adaptation takes time. And I have personally worked with a couple of people who are involved in regulation. The reason I wrote my book was because I was trying to address that transition factor more than anything else. And I'm happy to say I'm very optimistic about it. I'm seeing a lot of people who are in regulation who are talking about this very, very seriously today. And it's not a conversation which you have to kind of educate them about the basics. They know the jargon. They understand a lot of the complexities. Sometimes they ask you questions which you've not even thought about, but that's because it's normal. They're insiders. So I think it's never going to be easy, but there's a lot of progress that's being made. The real challenge is kind of reducing that time gap that exists between the commercial sector, which, because there's a lot of open innovation in which there's a liberation of ingenuity and a lot of cognitive diversity, allows for build up of new kinds of economic models at a scale which is very, very rapid. And on the other hand, you've got the institutions which are, they are the framework on which this economy works, and they're desperately trying to adapt to this new kind of economy. So there's always a gap between the two of them. And what we're seeing today is the reduction of that to a certain extent.
Yes, no, very true. There is always a transition phase that is very complex, and it involves a lot of change management. And there are a lot of parallel developments, parallel progress needs to happen when we are trying to re-establish, redefine, and redesign an entire, new economic system. It takes a huge amount of effort, and it's very complex. So it's totally understandable that and each nation is at a different maturity curve. So that when we talk about digitization and the digitalization of all the systems and processes and all, each nation is at a very different state. So it's going to be very complex task to bring everyone up to the speed and at the same level. So it's going to take probably years before we are able to.
I'd add just a little kind of a different angle on that.
Okay.
I agree with everything that you said, but there's a silver lining in all of this, in which, if you have to upgrade every kind of system, then a lot of the problems which actually exist with any form of digital transformation is attached to the legacy system that already exists in place. So if you look at a lot of banks, for example, I'm talking about commercial banks, we don't even have to talk about sovereign banks. You'll kind of see that their IT system is the spaghetti structure in which a lot of the base code is still done in COBOL. And to find someone who can actually transfer or update those things, it's very, very hard to do. So this is why I started getting interested in the blockchain, because my primary motivation to understand this aspect of economics was related to the fact that I was trying to figure out, is there an alternative definition to capitalism which is more in line with the current market structure and the market economy that we have? Because I find that there's a dissonance between the two. And what the blockchain is more than anything else is an infrastructural technology. So if you are looking at different kinds of nation states which are at different levels of maturity in terms of their digitalness, you could say, you can either try and do a sequential upgrade process, which is what a lot of them have done till today, or you now have an alternative in which you say, oh, we can kind of create a new infrastructure. We can use a new way to build up a digital economy using a new plumbing to a certain extent. So your grid work, your skeletal structure can be revamped using an alternative technology. And I think that's the silver lining, because it's an equalizer to a certain extent, which we didn't have before.
Sure, no, I understand your point, but at the same time, you also have to, we also have to take that into account, that whenever there is consumer-facing a change in technology or system or services, it is at the end of the day people who will be using those services or using those systems. So here, if you're talking about the payment system, then if you are looking at Asia or Europe or Africa, I mean, not Europe, Europe and the United States, and the Western country world, there are a lot of, literacy about the computers and how to, the smartphones and all that. But if you're looking at several other regions of the world, there are a lot of people who are not computer literate, and here we are talking about using these systems, digital systems, and having a mobile, payment systems, or having blockchain based systems, or any other technology based systems. So that requires computer literacy, and to bring everyone up to the speed, that is a huge effort. So I do understand, from the backend system and
Mm.
those legacy systems, it's easy to to make each nation come at the same level, because we can skip several generations. They don't have to go through what Western world has gone through in making progressive transition. But there is still a lot of effort that would be required to bring all the individuals across nations and make them computer literate to be able to benefit from this economic environment that we are developing. But having said that, I mean, it's not just that the credit cards that are helping to spell the demise of cash. We have seen over the years, mobile phones, mobile payments has also accelerated the move away from the hard cash currency.
Yeah.
Now, which technologies are playing a critical role in triggering the demise of cash? It is not, from what I see, it's not one technology, but it's several technologies that are playing a collective role.
Yeah. Yeah, I mean, technologies are essentially tools, right? And tools are always used to attack a certain kind of a problem. So if you've got inefficiencies which are happening in one system, then people are going to try to exploit that to solve a problem. And first it started off with credit cards, and then it started off with different forms of payment, like the M-Pesa movement, which happened in Africa, and today it's blockchain. And irrespective of the kind of technology, I think the writing is pretty clear on the wall that if you look at existing cash-based systems, there's high amounts of what's the word I'm looking for? The opposite of transparency, actually. So there's a lot of stuff that we don't know what happens with it. The countries that actually print fiat money have an incentive to keep it going on because they extract seigniorage from it. There's a huge amount of control that comes from it, and so there is a certain kind of political impetus in order to ensure that the existing system works because it's been tried and tested and it benefits certain groups of people. What we're seeing actually with these cashless systems, I mean, I think it's important to understand the cultural context behind it as well, because with more and more technology coming into the world, what we're seeing is an essential breakdown of the existing mechanistic hierarchies which exist in any economy. As these hierarchies become as they get broken down more and more because more people are able to access information easily through the internet, etc., it changes this collectivistic ethic which normally exists in hierarchical organizations towards a more rugged individualism in which each and every individual is more liberated to create value and ownership of value. So if this is actually happening, then it makes more sense for you to have a digital currency or a way in which you can accrue value and have it individually and transact between yourselves, because the existing architecture is in a state of collapse. So you need to have technologies which can address that and allow for this liberation to happen at an accelerated pace. So I agree with what you said that, yeah, there is a certain amount of literacy that is required for people. But quite honestly, a lot of people don't even know how the internet works. You talk to people and you say, do you know what TCP/IP is? And they're like, eh. So I think at the end of the day, if you can give someone, even in a poor country, if they've got access to the internet via a smartphone, and through that they can learn, and at the same time they can create value, and they now have a transaction mechanism which is natively aligned to this new architecture, then you're talking about a paradigm shift. And that's what people need to understand more than anything else.
Of course, that is going to be paradigm shift, but it also brings, you give everyone across nation, let's say, smart tools with internet connection and the ability to use these cashless transactions, irrespective of what format they use, whether it's Apple Pay or whether it's any other system, blockchain or whatever other system that that nation or that individual prefers. But when it comes to, we also know the complex security challenges cyberspace brings. So cybersecurity is, a huge problem. And now if individuals are not savvy enough in computer literacy, I mean, here we are talking about the move that I see is that with these wallets and digital wallets and cryptocurrencies, that everyone is going to become their own bank in the coming years. That's what the trend looks like. So you will be each individual will be responsible for its own security, for protecting their own money, in any format that is on their smartphone or on their laptops or computers. So
Yeah.
if they don't have that kind of computer literacy, how to protect, what kind of
Yeah.
antivirus programs to keep, or what to do, what not to do, what to do on social media, what not to do on social media, there are a lot of variables, coming to play here when we are talking about moving away from centralization, moving away from the system that somehow, like banks and other systems that protects the consumers, if their money is lost, that they would be refunded, or they won't be responsible for that if cybersecurity breaches happen in banks. Then, but here, when we are trying to develop a system where individuals will be responsible on their own, that's a whole different ball game, and I am not sure nations are ready for that, because even in Western countries, we don't see the security, savviness that should be there, if we are moving so rapidly towards digital systems. But that is a topic of whole other discussion, because the security is a very, very complex issue that would need to be addressed if we are trying to give that kind of power to each and every individual across nations
Yeah.
to be their own bank. And that's where I see a lot of concerns. But let's talk about this, blockchain. So the fundamental idea of no central authority that we are working on, that we see in the blockchain model of decentralization, the possibilities are so huge. Now, when we look at all the innovations that could help secure the client facing or the customer base across nations, the potential with what blockchain can do, if it's banking or capital markets, or trading or exchanges, overall economic system, the possibilities are so huge. So where do you see the blockchain, or how do you see the blockchain playing a very effective role if we talk about just the payment markets?
So payment markets. So I can hear the echo for some reason.
Payment. Yeah.
Yeah, so the payment markets are not really my area of speciality. I mean, I know a little bit about it. I think payment markets in the blockchain is kind of like a low-hanging fruit, in terms of the application of blockchain. And if you look at the original projects which were started off with blockchain, let's say in 2014, 2015 especially, the first markets which these blockchain entrepreneurs went and attacked was the payment market. And what they were essentially able to do was reduce that transaction cost, which normally happens when you're making any kind of transaction, right? This is something which I think is really, really important, because the only reason that we outsource trust and pay for that outsourcing to a bank is because they're insuring this, right? And they extract a heavy fee from it. Now, I don't mind paying for it, because I know that if I'm paying 2.5% for a transaction, it's because of the fact that the bank behind me is trying to ensure that there's the ALM and the KYC is done, and there's a lot of regulatory scrutiny which is done in order to ensure that we're not funding the wrong kind of initiatives, that there's protection for the consumer, etc., etc. So I'm happy about it. But when I start hearing about stuff like Western Union charging 30% because I have to send money to an underdeveloped country, I think that's daylight robbery. Keeping in mind that also a lot of the people who use services like the Western Union, sending money to countries which are underdeveloped, where there's a lot of unbanked, so they don't have an option, they have to use this. And as a result of it, the Western Union essentially has a monopoly in saying that, okay, fine, we are the new service which can allow you to provide, it can allow you to transfer value this way. So yeah, we're going to put this really, really high price point, extracting value from the poorest of a community. So I don't agree with that. And then you have this new technology that comes inside and says that, hey, we can change the way that this is actually happening. You will still pay a transaction fee, but because it's a decentralized network and it's distributed, the transaction fee is going to be very, very less. And all of a sudden, you've created an alternative to that. So it's no surprise to me that the existing incumbents are extremely worried about it. It's no surprise to me that companies like Earthport partnered with Ripple in order to ensure that by using Ripple's technology, they could reduce the amount of money that they were actually spending it for settling interbank settlements, because that's essentially what Ripple does. And they're able to do that in the billions. Their savings are huge. So this is an efficiency. It's a big efficiency. It is helping reduce the existing oligopolies which have existed in payment markets today. And I think any kind of competition which enters any kind of a sector is a step in the right direction.
Yes, no, I hear your point on that, and you made an interesting analysis on the insurance part, that why we have to pay those extra fees. And I see that as we go towards this cashless economy and as everyone becomes their own bank, I think we'll have to somehow come up with an insurance model which protects the individual consumers, because at the end of the day, everyone will need security, whether the banks provide that security to the consumers, or the insurance companies provide that security directly to the consumers. But we
Yeah.
will not be able to walk away from the security model, because nobody is expert enough to protect themselves when it comes to security in cyberspace. It's a very huge, complex challenge, and we
Yeah.
will to come up with a model. But that's again a topic of another discussion. It's very complex, and there is a lot to discuss, because we are redefining systems, and we'll have to at the same time take into consideration all those variables that provides the security, all those risks we will need to identify, because we do, while we want to move away from it seems like the nations wants to move away from that centralized authority and go decentralized. We still need to consider and put together efforts to how can we at the same time in parallel create an insurance structure framework or security framework. So those things still needs to be identified, but it seems that the blockchain technology is being signaled by so many as the ultimate back office makeover for the overall financial industry. So, I mean, we are not talking only about the payment in the aspect of it, but the overall financial industry. So, do you see the blockchain circumventing the global banking system entirely?
Well, I hope so. That's kind of like the thesis that I've based my work on. And it's also the project that I'm involved in right now, which is called Money by Design, is essentially trying to look at it from an institutional standpoint. So in my book, The Blockchain Alternative, what I explored as a concept was, what would happen if we tried to create a sovereign level blockchain? Like, imagine that, a country level blockchain existed, which would be some kind of a mega blockchain, which could be simplistic to a certain extent, but which would allow an entire economy to function on it. And then you could still have private blockchains and public blockchains, which exist, as they do today, but they would have some kind of girder, which would be the sovereign level blockchain. And it's not just for back office operations. I mean, back office operations is, again, that's a low hanging fruit kind of a situation. Yeah, definitely, it's going to help in that, and that's the reason why these banks are throwing millions into it. I just saw BBVA, for example. I just read an article recently, which was able to issue its first loan of 75 million using a smart contract. So they're definitely exploring it, an infrastructure upgrade that they can have. And a new kind of partnership that they can have with the private sector, which they were not able to do before. I think the real potential of the blockchain goes much further than that. There's a potential which can be explored from the private sector, and there's a minutiae of detail that we can get into because the granularity is so advanced. But from just the banking system per se, yes, the back office operations will be kind of like the first things to go. But then you can start thinking about it in much more different ways. Smart contracts can start automating a lot of the functionality, which actually uses a lot of people today, which is in tandem with the way that fintech is anyway changing the banking sector. So, this goes hand in glove with machine learning, deep learning, and all those different kinds of technologies. That's like a front end, you could say, application. This is more like, onto the scenes. And the reason that I was trying to explore this idea from a sovereign level was because I said, if we move to the blockchain, can we start thinking about new monetary policy tools? So that's the kind of level of thinking that I'm thinking about. It makes sense to me for us to switch towards a blockchain-based economic system, not just because of the fact that you'll have a more stringent and secure back office operation. That is definitely going to be there, and it comes with complications. There's scalability issues. There's a lot of stuff that needs to be hashed out. But there is another incentive for banks to kind of get into it and create new kinds of tools and create new kinds of operations which have not been able to do today. And that's what I'm exploring right now with the Money by Design project.
Sure, no, that's very exciting, and I think if we talk about the technology playing a huge role for the overall banking system, then we can cut out all the inefficient intermediaries, banking intermediaries. That I think it's probably where the focus is also, and the banks can also cut their infrastructure cost and increase the speed of execution. So there are a lot of benefits that the banks are seeing in exploring the blockchain model to move forward. But the ability of a blockchain technology to provide an unforgeable record of identity, that's what everyone is focusing on right now, to have a very that no one can compromise their identity, and
Yeah.
there is no fraud involved and things like that. That
Yeah.
the history of individual transactions is also one area that is being explored. I think, how do you see that being a useful application when we are looking at the payment industry for without having unforgeable record of identity? How will the blockchain be able to provide that benefits or the application to the payment industry if we haven't sorted that out yet?
Well, I don't know about the payment industry per se, but I often ask my students a question. I give a couple of classes in a couple of business schools, and I asked the question the other day to a bunch of students because they needed a subject to write a master's thesis on. And I said, okay, tell me, how would it change if a company was structured around the principles of the blockchain, which are the principles of transparency? So, look at the way that HSBC has been essentially just flaunting its might. It's been involved with money laundering for the Sinova cartel. I mean, the history of HSBC. There's a great documentary which came out earlier in the year by RT, shows how this bank essentially pretty much does what it wants. It's like a gangster bank, you could say, to a certain extent. Yet, even though there's this information that has come out, there's a lot of investigative journalism that has happened that shows this proof. If you walk through any airport today, and I know this because I've been traveling quite a bit in the past month, the first thing you see in most airports are these advertisements of HSBC, which line the entire walkway as you're going to catch a plane. And they're all talking about how they're having a social impact and liberating hope and all this hippie stuff. So think about the fact that if you were operating on a blockchain and your payments were done on the blockchain, and every time you were involved in some kind of a negative kind of a payment or something which had a bad effect on society, it would actually affect the way that your structure is there, because now you have an unfalsifiable memory, and that changes the entire strategy that a bank is going to be able to take, right? So we push away the cobwebs, we change the existing narrative, which has become this mantra that hasn't been changed for a long time. And for me, that's more important. I mean, processes and payments, yes, they're very, very important, but in what context? That's the kind of level at which I'm trying to operate in right now, because I have massive issues, mostly because of my past and experiences that I've had in the past with the current capitalistic system. And I think here's an opportunity for us. Yes, we can have efficiencies with back-end and payments and all those different things, but also create a new kind of organizational structure and a societal structure in the process.
Yes, of course, because the question is not whether the disruption that we are witnessing today will transform the overall banking and capital markets, but rather how will they be done. So the young generation, the students that you're talking to, they are the right people to think about these kind of problems, because they are our coming tomorrow, and the young people have so much ideas and imagination ability that they are the ones who will be able to guide, or will be able to play a major role in how to make that transformation. Because we here, like you just said, we are trying to create a new organizational paradigm, and we are trying to create new kinds of future, new kinds of digital savviness, and a whole new world of payments that is giving security, that is giving privacy, that is taking away the frauds and corruption, and it establishes trust and transparency. That's what we are looking at. So can you give some examples of disruptive innovation that is occurring both across business to business and consumer facing areas of financial services, uh, based on your observation?
Business to business, I think one great area which is really being explored right now is just with supply chain. Blockchain is having like a really great impact over there. I personally know about a company that's based over here in Paris, but they operate in New York as well, which is called Stratum. And Stratum has essentially created their own proof. So they don't use proof of work, they use proof of process. And it's quite simplistic, actually. If you look at their actual protocol and the way that it functions, it's really, really simple. But what they're essentially doing is they're using a new way in which you can track, from the production of something to the end user, the entire journey that happens, the supply chain journey. They're using the blockchain in order to validate and show different aspects of the transition from point A to point B. This has massive implications, especially when you look at what happens during the supply chain of pharmaceuticals. So pharma companies today, they spend a ridiculous amount of money in order to ensure against counterfeit, especially of drugs, certain kinds of drugs which are produced. If you can blockchainize that, which is a complete B2B solution from the point of creation to the point of sale to the end of it, you can be able to ensure that, if there's any tampering that's happening during the supply chain process. And that has massive savings for the supply chain industry and definitely for the pharma companies. So I know that Stratum is already doing this stuff with a bunch of different companies. I don't want to say which companies they're working with because I don't work there. I don't want to get into any problems with it. But just if you look at that area of B2B, that's one area. Another example with B2B, and this might be a bit of it might require a bit of a change in mindset, but we now have this concept of digital commodity and a sense of digital scarcity. So before, your commodities were like oil and land and this and that, and that still exists. But in an economy in which 65% is based on services, and most services are digital today, or they use a digital platform in order to execute that. You find out that there's new kinds of commodities which are extremely digital, like bandwidth, like computation power, like file sharing and storage, and all those different kinds of things. So what we're seeing today is that a lot of these new companies which are being created, like so there's IPFS, there's Filecoin, there's storage, there's Ethereum. All of these are essentially ways in which you can quantify, measure, and monetize these digital assets, these digital commodities, because these are the new commodities in the economy. And that's to be sale right there. So today, if I need to store my information, I got to use something like Amazon Web Services, right? Amazon Web Services, I'm paying something around 80-90 cents per gigabyte of storage. Now you look at a blockchain, and Amazon, by the way, even though it's based on the internet, it's completely siloed. I mean, the internet has become this weird siloed structure. We switch from Amazon to Google to Netflix to something else, but it's always to Facebook, and it's always in these these silos that exist on the internet. And when we put information on AWS, we're paying this amount of money, and that's pretty much it. There's a couple of other options, but they're all around the same price range. Now you have someone who comes up with a blockchain solution. So there's storage, STORJ. And they say, hey, you know what? We can connect different people on a decentralized architecture. And let's say that Jayashree's got 1 tera of free space sitting around at home. You're not really doing anything with it. Let's create that as an incentive. And now you can rent it. And there's a coin, which essentially you can sell your free space. And I'm looking for, play, in which you're going against a mega incumbent. And if there's anything that we've seen with decentralized systems, is that the scalability is so much more faster. So, this is like a pure B2B play that's happening right there. Coming to consumers, this is where it's going really bananas right now. It's going so fast, it's hard to keep up. And
this new model of sharing economy that we are seeing, because anybody can access with this sharing platforms that are being developed.
Yeah.
Like you said anybody can access anybody else's computer or data storage or all kinds of capabilities. So
Yeah.
it's an amazing.
It's not really accessing, but yeah, you can connect to them, and
Accessing in the sense
yeah,
that you can connect to that, you
there's a bond.
get
There's a bond.
accessibility to connect
Yeah,
to that,
yeah,
and you can then store your data, and that's a very interesting model that is being developed.
yeah.
But I mean, I mean, see the kind of amazing innovations are happening, like Amazon.
Mm.
I think they are also starting a cashless store where people won't have to even stop at the cash out.
Yeah, I'm waiting for that in Paris.
Cashless, nothing. So very interesting innovations are coming, but this distributed ledger technology
Yeah.
is likely going to be the foundation of these next generation financial services infrastructure that are being defined and designed and being developed. So but they also need some other technologies to be effective, and
Mhm.
when blockchain needs to merge with other transformative technologies.
Yeah.
I mean, single-handedly, blockchain will not be able to do that. It provides a digital platform, but it requires the other, integration of other technologies to
Mm.
make it successful, the whole transformation. So, which technologies do you think are merging with blockchain today, and will need to merge tomorrow if we want to create that effective transformation
Mhm.
based on blockchain?
Yeah. So technology has got this weird tendency to feed off other technology. I mean, if you look at any kind of innovation, I mean, innovation is a very loose term. When people say innovative, I don't understand what they're talking about. But if you look at the way that ingenuity or new discoveries are made, it's something which is called the combinatorial theory of technological evolution. And what you find is one technology essentially permutates and computates with another kind of technology to create a new technology. And you can see this, there's work done by Arthur Koestler, even E.O. Wilson. He wrote a lovely book called Consilience. More recently, you've got people like Stephen Wolfram, who created Wolfram Alpha. They've all kind of analyzed this stuff, and even Kevin Kelly has written about this. And what you find is every time you have any kind of technology, it will reach a certain kind of maturity level, you could say, which makes it capable of now interacting with other technologies and doing different kinds of things to create something new. With blockchain, there's so many ways in which this can go. First of all, if you're looking at these new digital commodities that I mentioned about, just in those commodities, there's so much innovation, there's so many different types of technologies that it can mix and match over there. So a simple example would be to look at these distributed grids, electricity grids. So you've got these electricity grids today, which are, the solar panels. So there's a lovely project which is happening in Utrecht in the Netherlands, in which what these guys have been able to do is, just as you've got Moore's law, you've got Swanson's law, which is the efficiency of solar cells to be able to convert it into electricity. And because of this, new capability of creating more and more energy with solar panels, this neighborhood in Utrecht said, hey, why don't we kind of capture as much energy as we can with these solar panels that we've installed at home, and we can create an alternative to the existing electricity grid which is provided by the government. Now, think about the fact that every electron that is produced from the solar panel thingy is a new digital asset. And now, if you want to be able to trade it with the adjacent neighborhood, which doesn't have as many solar grids as you do, or has no solar grids at all, you can now quantify it at a minuscule level. Because what a blockchain allows you to do, or any kind of cryptocurrency allows you to do, is have a large amount of divisibility, right? So, a euro or a dollar can only be divided to 100 cents, but a Satoshi is like 1/8 of a Bitcoin, right? So you can divide it up to 8 decimal points. And so you've got this ability right now to quantify these micro, very, very small digital commodities. And so you can see a natural partnership happening between new kinds of advances in solar production, electricity production, and this technology over here. So that's like a very straightforward one. If you want to keep it digital to digital, you can see there's a lot of work that's happening right now in terms of machine learning and blockchain. So you've got all this information that's being created with these transactions and this ledger in which you can see each and every transaction that's happening. What are you doing with it? What are you doing with it? I mean, this is a great thing to be data mined, right? You can start looking at how people are actually analyzing this information to kind of get an understanding of the economy in general, right? Or at least in a certain kind of economic sphere. And this changes a lot of things, because what we're learning in economics today is there's huge inefficiencies with efficient markets hypothesis and rational expectations theory. I mean, I have never met anyone who's rational. That phrase doesn't even make any sense to me. And we're using DSG models, dynamic stochastic general equilibrium models, to make monetary and fiscal policy, which is based on efficient markets hypothesis.
Yes.
So why can't we look at complexity economics instead? Complexity economics is based on looking at the interactions between agents. Okay, this is agent-based modeling. You require data for it. You have psychological data, behavioral economics to understand how the agent thinks. But you also need to know what the interaction is in terms of the value being transferred between people. And if you've got this database with all this information on the blockchain, you can use machine learning techniques in order to data mine that information. Now, it's not easy to do it. You can't just use the regular machine learning techniques that we use already to kind of, look at a bunch of cat images and figure out, oh, that's a cat. This is a bit more complicated to that. But I know that there's a lot of people looking at it right now. And if you follow, there's a bunch of these blogs on Medium and stuff like that. This is definitely something that people are doing it. I don't know if they're trying to do it in the context of what my motivation is, which is an alternative way of doing monetary policy and moving away from this efficient markets hypothesis business. But there's definitely that potential over there. So just with those two examples, you've got like a hardware kind of interrelationship, and you've got like a software to software interrelationship.
I'm glad you mentioned that. And complexity economics, I think I heard the term first time. It's interesting, concept. So yeah, no, definitely I will look into that and have someone on Risk Roundup to discuss that, because it does look like a very interesting topic, and where we are moving and what efforts are going to be necessary in the coming years. Now, if we look at the economic system, I mean, blockchain is giving us that capability to imagine, to move assets and liabilities and risk and rewards across borders, across nations' geographical boundaries and between institutions without paying huge transfer fees. That's probably one of the bigger incentives that, everyone was excited about. That is what blockchain technology promises us. Now, by removing barriers such as banks and prohibitive cost and waiting periods and regulatory restrictions and all the service providers connecting with the blockchain technology, it can open up so many systems, probably all the systems to entire nations. It will be a very different kind of transformation, where we are not just looking at, in silo the financial system or economic system. We are talking about the opening up of all the systems, because this financial system is integrated with all other, systems across nations. So we are talking about, opening up of each and every system across nations. So how do you see this being perceived across nations, as it will open up all systems to all nations? Do you see that decision makers across nations, or government or industries or organizations, academia, or any other players, they are being excited about this?
Oh yeah, sure, yeah. It's happening. It's happening in different pockets. So it's an emergent trend. Any technology, when it comes inside, it goes through that curve in which there's adoption, and then there's a trough of disillusionment, and then it becomes mainstream. And different people are at different points of it. So I remember when I was working, I used to work in academia before, till I realized that I wasn't suited for it. And when I spoke about blockchain over there, and I had to actually force the school to give a lecture for free, because I was like, students need to learn about this. Okay, so this is in 2014 actually. And when I mentioned this the first time, a lot of the people who were working with me in academia, they were like, yeah, it's a cool tech, but I don't see the real value behind it. And now what we're seeing is more and more people in academia, either from the natural sciences or even from the social sciences, who are realizing the transformative effect of it. And just today, I was looking at this website, which is called PeerWith or something like that, which is a way in which academics can come and put their papers or their research on their website. And they've created a token in which other people can kind of gauge how good the thing is. So it's like peer review, you could say, to a certain extent. And the number of likes or the number of upvotes that are received is converted directly into a token, which can then be exchanged. And so you're giving a financial incentive directly to the academic, which goes completely against this very, very macabre model of academic publishing today. It was one of the main reasons I ran away from academia, because I just didn't agree with this model that is used today in terms of academic publishing. It creates these very weird structures and mental maps, which I don't agree with. So just in academia, you can see that. Coming to countries, I mean, you can look at what's happening today with Singapore. Singapore is they've been funding Project Ubin for a long time. It's made some tremendous progress. The papers were released pretty recently as well. So Singapore is, and the MAS is looking to say that, okay, fine, we can use this in order to govern our economy in a very different way. You go to Dubai, and Dubai is trying to do a lot of their paperwork. They've kind of focused on that because apparently they have some issues with the paperwork, to switch that to the blockchain. You go to places like Iran, they're planning to issue their own cryptocurrency, which is backed by assets, which is a kind of an offshoot of what was done by Venezuela. And all these different countries are looking at it in different ways because they have their own individual hype cycles. They have their own ways of saying that this is my economy. And that's what I think is very, very powerful, because it allows for context relevance, which it's not that one size fits all kind of a thing. The protocol has got so many different elements in it. They have different blockchains, different protocols, different elements within it, that you can adapt it to the environment in which you're immersed in, or the economic environment in which you're immersed in. And the fact that you've got all these countries thinking about this and trying to understand what they can actually do with it is an indication of the fact that they are also looking for solutions. They're not just trying to be spectators, they're trying to be contenders, which changes the playing field completely, because now you have a common language to talk to the private sector. And I think that's what is missing today, because what you have today is this very weird situation. You've got these crypto enthusiasts and these paragons of blockchain who are very smart, and I love what they do, and I follow their things, and thank God for them. And they're creating this kind of digital utopia in which for them it's all about Austrian economics models, and you're seeing like the reincarnation of Hayek's denationalization of currency happening on this side. And then you've got the centralized system over here, which is these legacy systems. And they're centralized, this is decentralized. These guys are saying we can do this, these guys are saying, oh no, we can't do that. And in between, you've got the regulator who's kind of running around in between the two, desperately trying to make a handshake between the two of them. When you see that these countries are thinking about using a blockchain for addressing their own economic issues, you now realize that both these people are talking the same language, which allows for a better way to create policy. It allows for a better way to understand what the issues are. Because until and unless you have this, if you carry on having this separation, there's no chance that you can be able to fix the macroeconomic issues. And my specification, and I'll just end on that point, that it's very, very important to understand that public debt becomes, private debt ultimately becomes public debt. It's something which Adair Turner calls economic pollution. So if you have problems over here and you're not speaking the same language as this system, you're creating more complexity. If you're at least in the same kind of system which allows for a greater amount of transparency, maybe you can have better detection. Maybe you'll be able to figure out what's actually happening. Maybe it'll be easier to see systemic risk, right? Yes. Because of this transparency. And that's my motivation of trying to identify a niche within the blockchain universe. Selected macroeconomics because it's the field that I was most comfortable with.
Sure, no, that's an interesting point, Kary. But I mean, if you're talking about the transparency that benefits that it would provide, it also brings many complex challenges, because right now, if you see that as we withdraw cash from the society, and India, I think, is a good example of that. They tried to do demonetization, and their efforts.
It's a bad example.
If they go towards that, then across many nations, you see today that there is still negative interest rates, and making the idea of a cashless economy is creating more complex challenges, because does a fully cashless society, do you think it would make a really good economic sense? Because there are so many complex challenges. One is a negative interest rate, and then there is with this electronic payment, individuals, the people, citizens, they lose the
Mm.
power of actually
Yeah,
make seeing how much they are spending. They won't realize, because you just slide the credit card, you slice it, pay with the phone, you don't realize you have a cash in your hand.
sure. I mean, it's no one is saying that we have to completely get rid of cash. If it makes sense to have cash in certain situations, yeah, go for it. No one's telling you that you need to get rid of it. My question in that case is to say, what is the balance? Like, who is coming up with the decision in which they're saying that, okay, fine, we need to have that much money in digital and this much money in cash? So first, let's have that conversation. Secondly, what you mentioned about India, I mean, India was a really bad example of demonetization. It was hastily done. There's been a lot of criticism about it, and the man who actually came up with the execution of the project was totally unqualified for it, and that's come out later on. So I don't know what the Modi government was thinking when they did it. It seemed to be a good idea at the time, but they should have probably done it in a much more. They should have done it at a rate at which it could be absorbed, and not in this way, in this like, okay, fine, we're taking away this money. I mean, what's going on? Secondly, your point about negative interest rates. The reason that we have negative interest rates is simply because of the fact that every time a government tries to control the economy, they use, a couple of tools. One of the tools that they have is interest rates. Another tool that they have is controlling inflation. But let's think about it in a different way. Imagine that instead of having dollars or euros, we started shifting towards a system which was like a dollar coin or a euro coin. Now, remember the point that I made about the fact that you can divide $1 to 100 cents, but you can divide one digital currency to 8 or 10 or 15 places. So let's say that the economy has got, I don't know, 10 billion euros, right? And that 10 billion euros is represented by 10 billion euro coins. Now, if I want to be able to increase or control the monetary supply, what am I doing today? I'm pumping money, which gets expanded through the fractional banking process. And I'm trying to control all of that with that lever of interest rate and inflation. Instead of that, if I have a digital system, cashless system, in which I have Eurocoin, instead of adding more money, I shift the decimal place to the right. So before you had, I don't know, let's say 10,000 euros, because I've shifted that decimal place to the right, it's now become 100,000. The volume of cash is essentially the same, but the quantity of units of money has now increased. And you can do this, up to 8 decimal places, 15 decimal places. You now have a new monetary policy tool, which you didn't have before. And now that's what I think is interesting to explore. That's just one very simplistic example. It's a bit counterintuitive because we're so used to, always pumping more money inside.
Yes.
And this is the kind of stuff that I think policy makers should be thinking about. They are not handcuffed to the existing paradigm. They are not handcuffed to it. They were. You've got a new alternative right now. Stop thinking about just like, okay, transaction and, back end and payment. Sure, those are the quick wins. Those are things that you should definitely explore. If it's helping you save money and getting you greater efficiency, you'd be foolish not to do it. But you can build up on this. And there's people at the Bank of England who are doing this right now. So Bank of England, I think at the level of thinking, they're pretty, I'd say that they're up there. And with Andy Haldane and his whole team of people who's working on it, they're doing some fascinating work. So they're my go-to reference point if I want to see like the best of what can come out of macroeconomics plus blockchain plus complexity economics. So yeah.
No, that's a very interesting analysis. I think there are a lot of different variables that we still do need to address that. And if we are talking about cryptocurrency, I mean, see that this basically comes down to trust. And when there is a monopoly by governments, on the currency right now, everywhere, all across nations. So and we are trying to remove the cash from the currency. That is the effort of a lot of innovators. Now, when we are looking at cryptocurrencies, it is created entirely through computer code. I mean, if you look at bitcoins or any other currency, so when this is more for computer literate people, because when you have to mine the currency, to get the bitcoins. That requires computer literacy, and not everyone has that. So these bitcoins and cryptocurrencies are created more for computer literate generation.
I don't agree with that at all.
But who? How would the older people mine? How would the people who have
I
no
mean,
understanding?
my mother, she's never read my book. I gave a copy of my book to my mom, and she said the print is too small, and she kept it on the side. Now she
Really, that's it.
yeah.
But there
No,
are
she
many
looked at it
people
and she's like, okay, I'll read it then. I'll read it tomorrow, and tomorrow never came. So I keep whenever I call her, I'm like, so which page are you on? And she keeps lying to me, and it's this ongoing lying
What's the
contest.
matter? Your mother is going to read anything you write, so and she's going to get excited.
I hope she sees this, because that will probably motivate her to
No,
do that.
when I wrote my first book, I know my son took a copy and he just put it in his, treasure chest. It was a big deal to him, So that is a familial thing,
Yeah.
Every
But
family.
the point that I was trying to make with that example is, even though she's not interested in all this stuff, but she loves talking to her grandson, all right, my nephew, and she's become very adept with using like everything, Skype, WhatsApp, this, that. She's up there, she's posting stuff, she's out there right now.
That's good. That's
Yeah,
good. And she wants to keep up with the changing times, but not, you don't see that eagerness or excitement in all adults, all senior
no, you
citizens.
don't. But the point of the matter is, she doesn't know how the internet works. If I tell her about TCP/IP and data packets and the way that we're sharding this and we're putting it over there and all that stuff, she doesn't care about it. What she cares about is, I click this button and I see my grandson's face and I can FaceTime with him. That's it. It's the same thing with these kind of technologies. Yes, the people who are actually creating it have to be technologically very literate, and they're very, very competent. They know a lot of stuff in cryptography, encryption, game theory, economic models, and all that. Before, we were outsourcing all of this stuff to a bank, and they were doing it in the centralized function. It worked. It had inefficiencies. We used a new technology to address those inefficiencies. The only difference is the people who are creating it this time is not a bank. It's these experts and these miners and all these different kinds of people who are creating it. I don't mind. I have Bitcoin, I have Ethereum, I have invested in a couple of
You may
tokens
have
as well.
purchased that, right? So, but that's
Yeah,
a very different thing. Buying the cryptocurrency is one
yeah,
thing, and mining it and
sure.
generating
But
that's
that's
a whole
my
different
point. The point that I'm trying to make is, I need to use cryptocurrency for whatever ends and purposes that I want. If I am not technically qualified to mine it and all those different things, that doesn't mean I can't participate. And
yes.
this
Yes.
is this is the main point. So you're trying to kind of if you don't understand how this stuff works, guess what? You can learn it.
Yeah, of
Okay.
course. No, I agree with your point on that.
Yeah.
It's not going to prohibit or prevent your participation.
Yeah.
So there will be ways. I agree to that. There is, everyone will be able to participate, but
Mm.
it is still a tilted playing field, which is more beneficial to computer literate people. And also, the second point is that the evolution in money that we are seeing now is
Mm.
very different than the previous ones. The evolving format of money based on the cryptocurrency, it brings nations an entirely different kind of monetary system that is
Yeah.
not backed by any government or bank, but is created entirely through computer code. So that is a very complex challenge. So do you think this is going to work where
Yeah, sure.
there is no
Yeah.
one backing it?
Yeah, I mean, like, what is value in any case? I mean, value comes from anything based on scarcity and difficulty. I mean, those are the two kind of core elements of value. I mean, if I have to go and get something, I have to put in effort. And because I've put in the effort and the time and the sweat and the blood in order to get it, I now come to you and say that, well, it took me this much amount of time to write this or to get this. So you are now going to pay me this much amount. And that is some way representative of what effort I've put inside over there. So this is where the value is actually coming from. I mean, don't forget that every currency, the average lifespan of the currency is 34 years. Okay. And there's something which is known as Gresham's law, which says that good money drives out bad money. So during the course of our life, it's normal for us to see like two currencies in our lifetime. One will go out. The only reason the US dollar has got such an extended lifespan is because of the fact that they were able to get their hooks inside a lot of deals and make it the reserve currency of the world to a certain extent. So it's an anomaly. So the transition of moving from one currency type to another is normal. We've seen it throughout history. Once a certain kind of currency ceases to have a lot of value, we can't go to something else. You look at fiat currencies today, the value comes from the scarcity of it. That's the reason why you're trying to have Basel III laws, because it's controlling the amount of debt to capital ratios that are coming out over there. It's the same thing with cryptocurrency. The miners who are creating it, they are putting in work. Proof of work is exactly that. They're using computation power. They're trying to figure out the nonce, how many zeros are there in it. And in the process of doing that, you do that whole hashing function. And in the process of doing that, they're presenting to the world, I have done the work in order to validate these transactions. You can verify it because once you've done it, the format of the hash that comes out after you do this work, it has a certain kind of a form. So it's like taking a jigsaw puzzle and arranging it in a way to make it a rectangle. And you show the world that, here, I've done the work, I put the jigsaw puzzle together, it's a rectangle. Everyone says, yeah, he's done it, and you get paid in Bitcoin for that. So it's this combination of the work that's put inside and the scarcity of the amount of this asset, you could say, this token. That's where the value actually lies. And any kind of monetary system, don't forget, Jayashree, money is imaginary. We came up with it, and a lot of people forget about that quite often. So I agree with the fact that, we are moving to a new kind of way of thinking about the concept of quantifying value. And before it was a lot more simple. We used to have gold. Then after Bretton Woods, we said, okay, no more gold. Now we're going towards fiat currency. And from fiat currency, we said, okay, this is the way that we're going to be able to value this value. What is the value of $1 compared to euro? And they said, oh, it's based on all these different kinds of parameters, but it's always related to scarcity and the amount of output that a country can actually give. So that's the work. You're having a similar kind of analogy with this very young technology, which is essentially rewriting the same story. But the precepts on what they're rewriting, that hasn't changed at all, right? So that's the way that I look at it. It's just a transition.
Sure. No, I hear your point on that. Now, going back to the point that you made about miners, that they put in work, so they get paid, in the terms of, getting Bitcoins or any other cryptocurrency, which is fair that they are putting in work. But I have a big problem when they use other people's computers without their permissions, and try to do mining. That's where, I think it gets off limits, that no miner has a right to use other people's computer. Then you are not getting paid on your work. You are stealing other people's computing power, and that is not there should be a law against these miners using.
Could you explain that example a bit more? Because I'm a bit confused. What I know about miners is, some of these miners might hack someone else's computer. But most miners, they have their own investment, they have their own grid. It's very expensive.
No, I'm not talking about most miners. There are a lot of miners who are. I don't have an exact example to give you, but this has been reported widely that they use other people's computer, they use other people's electricity and all the assets, and they do the mining. That is there's a lot written about that. You'll be able to see that on internet. There are a lot of articles about that. There should be some law against it, and I'm sure that this cryptocurrency industry is also aware about this problem. And I think there should be some laws against it, because you are not. Nobody should be allowed to use other people's assets without
Yeah, sure. Yeah, there's no doubt about that.
So, having said that, you have been actively working in this field. What are some of the big concerns you have as we move towards cashless economy?
It's a long list. I'm trying to figure out what is the maybe one or 2 points.
Especially, the points that you would like to emphasize, so that these young minds that are out there who are thinking about how to solve big problems, how to create some advantage systems to help the nation or the humanity, those kind of big problems that still needs to be solved around this.
My main problem right now is with the ICOs and the speculation. I think there's just been a gigantic quantity of bullshit that's been associated with it, and they took this really interesting idea, and to be honest, I don't feel sorry for anyone who got scammed by it, because this technology, it's hard stuff. Okay, you need to, if you want to invest in it, you need to spend around 2-3 months solid, just kind of getting into it and absorbing all of it. Anyone who comes up to me, I'm surprised by the number of people who've told me, yeah, I'm investing in tokens or ICOs. And I'm like, oh, did you read Satoshi's paper? And they're like, huh? I don't know what that is. So they don't even know the the basic principles. So because of I'm angry about it more than anything else than concerned, because there's so much speculation that's happened, and it was, we saw that in 2017, huh? When the price of the Bitcoin just skyrocketed and hit like $20,000 at one point of time. So what I think is what concerns me is the fact that this misuse of this technology in that way, and the fact that there are people out there who are doing crazy things like pump and dump schemes right now, in which they inflate the price of the token and then they crash it immediately. If you try to do that with stocks, you'd go to jail. That's like insider trading and stuff like that. But it's happening in a very rampant kind of a way in blockchain. So now, kudos to them. It's self-correcting, because when certain actors saw that this was happening, they kind of raised their hand and they said, that's wrong. That is something which really concerns me today, because it gives this negative connotation to this very promising technology. And I think that's what people need to kind of develop. If you don't speculate, if you want to speculate, fine, but do it in a way in which you nevertheless exhibit a mature relationship with this technology.
Yes.
And that's not the case today. It's not at all the case. And that's a primary concern for me, because it represents the mindset more than anything else. And it's very hard to change that.
Yes, absolutely. And that's an excellent example. The hype around ICOs is so big, crazy that people are losing their ability to see what is genuine and what is not genuine. And what you talked about, the Bitcoin offload, it's an excellent example, because the whole ecosystem that is supposed to grow in parallel to protect those kind of incidents is not there. Like you said, if that had happened, in trading, insider trading, people would have gone to jail. But it doesn't happen in the Bitcoins and cryptocurrencies, because the system has not developed and has not matured.
Yeah, and it's happened in the contemporary financial system as well. You look at what happened in the market crash which happened in the 1930s. You look at Ponzi schemes. You look at Bernie Madoff. You look at all these different things which have happened. That's fine. So that's kind of like my point about it, and that's the reason I got into money by design. So I want to talk a little bit about that project, because I want to be able to show that there is an alternative to the speculation.
Yes, please go ahead.
So the Money by Design project was created by Olivier Roca, and I joined him a little bit later on, and we co-wrote the white paper together. So you can find it on moneybydesign.io. And my problem with this, the speculation and ICOs, when I met Olivier and I started speaking to him about it, he said, I think there's a way that we can address this issue. And he cited Metcalfe's law. And Metcalfe's law, have you heard of Metcalfe's law?
No, I'm not.
So Metcalfe's law is like when the internet was first kind of becoming the internet. There was this transitionary period in which you had the Ethernet. And Bob Metcalfe, was the guy who essentially created the Ethernet. And what he realized was he started off with this marketing gimmick. It was essentially a marketing gimmick in which he told the salespeople that what you need to convince the end users is that if they're buying computers and installing an Ethernet over there, then the value of that Ethernet is going to increase based on the number of users that they have. So the more users they have, the more they can share information, the more they can get value from this. And what he did was he had done this a little bit before, so he created this very simplistic graph in which he said that the value is proportional to the square of the number of users. 40 years down the line, it's become Metcalfe's law. So he didn't call it Metcalfe's law, someone else did. And 40 years later, he said, you know what, let me check if this actually makes sense. Because when you say it's a law, that means it's like something that exists throughout eternity. So he went to Facebook, and he managed to get data for 10 years on the number of users and the value of Facebook. And value over here was represented by the revenue that they were creating, which was generally from advertisements. And what he found was this very beautiful kind of graph. It was like a sigmoidal curve, like a logarithmic kind of a curve, which showed that, yes, the value is proportional to the square of users. So I found that pretty interesting. And what was even more interesting was 2 years later on, there was a few mathematicians and researchers in China who repeated the same thing with Tencent. And they used the same time scale, and they looked at Tencent. And Tencent is a very different kind of a network compared to what's it called Facebook. But they found the same kind of curve again. So the moment we saw this, we said that, okay, fine, is there a way for us to be able to give an intrinsic value of a token? If you're taking a token and we don't want to be doing the speculation nonsense, we have to be able to say that this token's price is connected to some intrinsic value. Because don't forget that a blockchain is essentially an endogenous monetary system, right? So we said, okay, fine, Metcalfe's law is kind of, helping us kind of figure that out. And what we found later on was we kind of explored this idea, and we were able to figure out that we can actually tie the value of the token to the size and the connectivity of the network. Just because you have a number of users, that's not enough. You need this ecosystem to live. It has to breathe. And the way that it's actually breathing and showing value is when the connectivity is happening between it. And we came up with a formula, which you can find in our white paper, that the value of the token is related to the number of users. And the formula that we came was P is equal to, P in this case is the price of the token, is equal to 0.01 multiplied by N, where N represents the number of users, to the power of 5 by 4. And the reason it's 5 by 4 is because we looked at a lot of social dynamic structures, and we found that there's this power law that's over there. So it's a bit exponential, but it's not a complete exponential kind of a curve, right? We call this the scaling factor. And once we kind of got this concept, going on, we then said, okay, fine, how do we ensure that we can actually control the price as well? And we find that the control actually happens based on the number of transactions. If you have a number of people who have tokens, but they're just holding on to the tokens, they're not really doing anything with it, then it's not something which should have a lot of value, because the value is then based on speculation. They're hoping that it's going to be used, so they hold on to it. So what we said was we can actually figure out a way in which the number of transactions and the liquidity per se of the token can have an effect on the price, and it can be used in a control mechanism. Once again, we did a bit of calculations, and what we were able to find out was, what we decided upon was, let's say that the previous day there was a certain amount of exchange of value with the tokens. We use that as a reference. And once we use that as a reference, we then were able to say that if the amount of transactions falls below a certain threshold limit, then the value of the token will go down, or the price of the token will go down. So it's an auto-correcting mechanism, which doesn't incentivize you to hold on to it, right? And based on our calculations, what we were able to figure out was that if there is no change, let's say that the amount of transactions is the same, if there's no transaction compared to the previous day, then the first day, the value would go down by minus 0.8%. If it's just half the amount of transaction that happened the day before, it would be minus 0.4%. And you kind of build this up. If it goes up to 3 months, it's going to become 70% less. And if there's no transactions at all for an entire year, then the value will be completely zero. And we proved this mathematically. So there's a paper which shows all of this stuff mathematically. I'm just going to look at the calculation that we did, because what we figured out was, based on Metcalfe's law and this way in which we're trying to control the price of the token based on the utilization of the token, we came up with this beautiful curve, which was very representative of the same thing as Metcalfe's law. And if you have one user today, we have selected that the price of the token is going to be 10 cents. Oh, sorry, 1 euro cent. Okay, 1 cent. Once you come up to, let's say, around 100,000, based on these variables that we put in place and these control mechanisms, the value would go up to, let's say, 17 cents. And when you get to 100 million users, the price of the token would be 1.8 cents, 1.8 euros, sorry. Okay. So it kind of like builds up in this way. And what the Money by Design project has essentially done is found out a way in which, based on the usage and the size of the network, that you can have an actual intrinsic token price. And if you want to speculate it, remember that speculation happens on exchanges. So we don't want to put our stuff on those exchanges. And the reason that we made this choice is because we are essentially creating a blockchain with a token which has multiple functionality, and at the same time has got this stable price attached to it. Because this stability is what can be used by large institutions. I'm talking about central banks. I'm talking about big institutions which today try to kind of help us govern our economy. The reason that banks don't want to be able to switch to the blockchain, or they want to use the blockchain only for payment transactions, is because if they try to use a token, this volatility that happens with tokens completely undermines their value. So by showing that we can actually create a token which can be stabilized based on very simple parameters and with it's quite simplistic actually, the calculation, we've been able to show that, yeah, we can actually provide you with a blockchain with multi-functionality and a token which you can use because the price is stable, and you can see all of it happening right there. So it's the first time that someone's actually kind of looked at it this way. I'm pretty sure that as time goes on and more people realize that ICOs need to be done in a much more sensible way, that this is definitely going to become a norm. And it's the reason why BNP Paribas is working along with us. We're in talks with the World Bank and the IMF. We're kind of showing this to them. We've also spoken to the Autorité Marché Française, which is the financial control authority in France. And all of them are kind of looking into this because you remember what we had mentioned at the very beginning of this conversation. We need to be able to have some way in which this centralized system needs to communicate with this decentralized system. And the only way that you can do that is you give the centralized system the necessary tools for them to do their existing functions, augment their existing functions, and still provide some sense of stability. This project is related exactly to that.
Very interesting. Very interesting. Where can we find? Sorry about that. Where can we find the white paper? What is the website?
So it's moneybydesign.io.
Okay.
We just about finished this new predictive formula because we had to get a couple of people who work as traders, who work with exchanges. That's not my area of specialty. I was actually taken on as a scientific advisor and writing the white paper in terms of kind of like saying that, okay, fine. It was an extension of a lot of the ideas that I'd expressed in my book. But this kind of, the mathy stuff which needs to be done, we needed to get someone who was better qualified than me. And he just finished this. So it's really new. We've already got the white paper out on the website. It's a 77-page white paper, so it's not a quick read. But we're going to be adding this stuff inside because this offers investors a much more interesting way of looking at it, especially institutional investors.
Yes, absolutely.
We don't want investors who are speculators. We want investors who are users. Sure. And if you want to use it and you want to, you can come inside and you can see the price. You can see exactly what's going on. You can understand the way that the intrinsic value of this token is calculated. The more people join, the more use that it has, the value goes up, right? And if the trading stops, it will autocorrect itself. So we are not looking for, that one day I wake up and I find we call it the geo token. I don't want to find the geo token trading at, $20,000 a token, because that means that it's not fungible anymore. It's not something that can be used properly to sustain an economy. And we have been completely obsessed with this concept of really liberating the power of the blockchain to institutions.
Yes, I see that. What would you like to tell our global viewers and listeners, especially about your book, The Blockchain Alternative, and where they can find it?
You can get The Blockchain Alternative on Springer. So you can go to Springer's website, you can go to Apress, you can go to Amazon. It's available on Amazon. You just put The Blockchain Alternative and you should be able to find it pretty easily. The book it's an introductory book. It's a bit academic because I've published with Springer, so you've got to be a bit academic when you publish with them. But there's a lot of concepts which I introduced over there. It's only got 4 chapters. It's around 250 pages, but it's got 4 chapters. And what I'm trying to provide in that book was, the motivation for it was, let's have this kind of a conversation. Why are we always conversing about the applications of blockchain? We should be conversing about the implications of it. And for implications, especially large-scale implications, let's start thinking about this concept of a sovereign-level blockchain. So there's a lot of things which I've said over there which are just conversation starters, because I wanted this book to be a precursor to anything else. I talk about, I point out a lot of flaws with the existing system. I then talk about what my conception is about this sovereign-level blockchain. And the final chapter is actually completely dedicated to complexity economics. because I needed people to understand the match between complexity economics and, so it's problem, solution, future. That's kind of like the way that it's organized.
Good, good. No, very good. I look forward to reading that, and I'm sure our global viewers and listeners are also, going to be interested in that book to get that foundational understanding about the blockchain and what it could lead to, and the kind of future and the tomorrow that it could provide all of us and all the systems across nations. So, thank you so much, Kary, for participating in this roundup today. We appreciate your thoughtful insight on cashless economy and especially blockchain. Our global viewers and listeners would benefit tremendously from the understanding you provided on how the blockchain alternative helps us to take a step forward. So even if a single individual or entity can innovate and help the broader financial industry take a step forward based on the understanding they receive from this discussion we had today, this discount of dialogue has been of service, and we thank you for that.
Pleasure. Thank you so much for having me on.
Wonderful. So while there is a growing excitement that cashless economy marks the beginning of a new era, there are many complex challenges that need to be overcome. Risk groups, cybersecurity, geosecurity, and space security risk research centers are created to identify, evaluate, and manage the risk facing NGIOA CTS designations with government, industries, organizations, and academia in cyberspace, geospace, and space. We at Risk Group believe that risk management, security, and peace, they walk together hand in hand. So security is related to management of threats and peace to the management of conflict. Risk management is related to management of security vulnerabilities as well as management of conflict. And it is not possible to conceive any one of the two without the existence of the other two. All three contribute into each other. We believe that the security we build for ourselves is precarious and uncertain until it is secure for everyone across nations. Tradition becomes our security, so if we build a culture of managing risk effectively, it will lead us to security, and security will lead us to peace. Let's manage the existing and emerging risks together. For more information on the Risk Roundups, to other Risk Roundup videos, or hear the Risk Roundup podcast, please go to riskgroupllc.com and do not forget to subscribe and share. Until next time, I'm Jayshree, host of Risk Roundup, signing off. See you next time. Thank you.